please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to our special results season heads up, quarter se quarter tak. I'm Lata Venkatesh and with me my colleague Prashant Nair, and between us over the next half an hour, our research team will analyze the performance of over 7 sectors ranging from banks to capital goods, metals, oil and gas, cement and what have you.
Hi Lata. In the previous edition of Quarter Se Quarter Tak, we had already analysed 4 sectors: IT, auto, FMCG and pharma. And to give us their expert views on these 7 sectors we are analysing today, we have Gautam Duggar of Motilal Oswal Securities and Sanjeev Bhasin of IIFL.
Well, like in the past 4 years, FY19 also sees Dalal Street start the year with big expectation. The FY19 revenue growth is expected at about 17%. This is an average of several brokerages, while net profit growth, that is earnings growth, is expected at 19%. However, the start could be muted. Kotak, for instance, told us that the first quarter net income growth may be flat. That's because what autos, consumer goods and pharma bring to the table, corporate banks, both public and private sector, could take away, and so could telecom, and that could bring the average down.
Okay, so that kind of sort of sets us up in an overall way, but let's dive straight in. We've got a lot to cover. What can we expect from the banking sector in the first quarter? Our in-house banking expert, Abhishek Kothari, is standing by with expectations, key expectations. Abhishek.
Loan growth in Q1 FY19 has picked up to 13% on a YY basis, and you expect slippages to trend downwards sequentially given the fact that large part of asset recognition was done in Q4 FY18. However, NII is expected to remain on the lower side, and some respite can be seen on the treasury losses that the banks will carry due to the fact that RBI has given them permission to amortize the losses over the next 4 quarters. Elevated provisions will be seen for corporate-facing banks, and therefore weak earnings are seen for banking stocks on account of lower NII growth, muted other income and high provisions. Kotak Securities estimates a loss for SBI and Bank of Baroda, while they say that for ICICI Bank and Axis Bank, NII growth will be 5% on a YY basis, but profit will be down 98 to 99%.
Okay, thank you very much. Well, quickly, Sanjeev, corporate-facing banks, do you think the private sector banks can spring a surprise? I mean, they've had their own set of management-related problems. Just to prove a point, do you think we could get some out-of-the-world outlier numbers from Axis and ICICI?
Yeah, I think they could. They could surprise because it is a big balance sheet, and they had done a lot of write-downs. Now, if there is some write-back, and that could be, more to do with, say, a State Bank or a Bank of Baroda also, given that Bhushan Steel and some of the other cases are being resolved, and the State Bank chairman also indicated that the next few quarters could see a lot of write-backs. But like you said, I think the surprise packet could be Axis and ICICI. Even though interest income may be muted, I still think there could be a little bit of a write back, and that could surprise on the provisioning front on the corporate banks.
Gautam, for you, which is the bank which you would watch the closest? I mean, satisfying 2 conditions. One, the stock price poised to react to a surprise, and maybe we'll get a surprise, actually get a surprise.
So Prashant, at least in the first half, we are not expecting any fireworks from the corporate banks. Whatever write-backs of provisioning and moderation in provisioning cost is more likely to be a 2H FY19 story according to us, and therefore the first half of FY19 is going to be more of the same that we have seen in the last 7-8 quarters, which is that private retail banks continue to grow at 23-25% profit growth. The corporate banks continue to have a lot of volatility in the earnings depending on how they decide to take the provisions. We are, for the quarter at least, expecting 40% YOY decline in Axis Bank's profit, and ICICI Bank also we are expecting a YOY 10% decline. Now, obviously, there are too many moving parts for a lot of these banks, so any change in item or change in line item here and there can have a big surprise or disappointment versus expectations. For us, it's going to be still a case of continuing with the retail private banks and then see as we move closer to September whether whatever has been hoped for so far, whether it gets delivered or not.
Okay. Well, from banks, we go to the ministry that is supposed to have performed the best, roads and therefore capital goods. Anisha is here with the expectation.
Well, yes, we're looking at a double-digit top-line growth for the capital goods and industrial space, given the fact that the opening order book was healthy as well as execution has been steady. And to add to the comfort level, there was a low base of last year. So for the likes of L&T, we are working with the 8 to 9% top-line growth, though the order book might decline because the order inflows were really tepid in the quarter gone by. Now, similar is the story for road sector as well, because we are looking at a top-line growth of 10 to 12%, but it will differ on a company-to-company basis because of a lot of companies had a heavy execution, the pre-GST execution last year, and that should impact the base for them. Other than that, the order inflow has been tepid. For the likes of NBCC, we are looking at a 15 to 20% top-line growth, while the likes of IRB might report a decline in revenues given the weak execution. Back to you.
Which segment, Gautam, according to you, is sort of likely to stand out in the quarter?
I think as far as we are concerned, we have a very limited coverage on infrastructure. So what we cover is capital goods and some road companies. The road companies have been doing quite well over the last year and a half, and the awards as well as execution has been very strong. We're expecting very strong quarter from L&T this time. Obviously, the base is very favorable. There were some write-offs in the base. So year-on-year growth, we are looking at more than 60%. Last quarter was also very good for L&T. For our coverage universe, L&T actually accounts for almost 50% of the total, profit pool. But if you look at the data which is coming from CMI couple of days back, whether it is project announcement or project completion or new project starts, it's looking very muted. So I think the private capex cycle still looks far away. We have to stay with strong names within that. In fact, we are not seeing much capex, to be honest. We are seeing capex only in some segment like steel, cement, and maybe refining. But by and large, the broader capex cycle has not revived.
Okay, so strong numbers only from L&T, helped by a base. Okay, let's get to metals and then go to Sanjeev. Nigel, of course, metals have had a very good year, I think, but they've had a very good last 2 years. You tell us for this quarter, Nigel.
Well, Edelweiss expects the metal space to deliver a good set of numbers, particularly for the ferrous space, while non-ferrous should be under some pressure. Why does the ferrous space deliver a good set of numbers? Higher volumes and spreads have been at multi-year highs. Hence, for Tata Steel, you're expecting the EBITDA to jump up by around 40%. The profit number should more than double, while for JSPL, the EBITDA as well as the profit number, that in fact should look quite good. The revenue should jump up by around 50% approximately. The non-ferrous space, though, the EBITDA number should get a bit of a knock. Why is that? Because input costs have spiked up. So for Hindalco, on the top line as well as on the EBITDA number and the profit number, you're expecting a bit of a degrowth. In terms of Coal India, well, the EBITDA number should be good because the volumes are higher as well as realizations are higher. Finally, for NMDC, expect a bit of a dent because of lower volumes.
Okay, essentially cyclical industries. So Sanjeev, has the cycle peaked? Do you like any of these metal stocks, including in the same basket, Coal India and NMDC? Anything you like in this space?
Yeah, so Lata, I think, firstly, Tata Steel will be an outperformer, given that they've indicated last 2 quarters their EBITDA per ton has been the highest, and I think that will be maintained for this quarter also. The other 2 surprises would be JSW Steel and SAIL. They're both integrated plays, and SAIL has shown a lot of cost cutting in the last 2 quarters. SAIL could be a strong surprise on the cost and the EBITDA per ton. Coming to the other place, I would say Hindalco will be may surprise, given that Novelis has turned around very strongly and the Canadian loonie has been a very strong hedge against the US dollar. On NMDC, prices have disappointed, and I think that will again, it's evident from the volume front also that will be a little bit of a disappointment. But Coal India, given that last quarter they have accounted for most of their one-offs in the shape of pension and other events, this quarter could be a turnaround and Coal India could surprise on the upside.
Okay, Sanjeev, thank you very much for that. I mean, so that is metals, a record quarter for steel companies in some cases, and good quarter for non-ferrous as well. From metals, let's move on to oil and gas. Let's set it up with Sonal Bhutra, who's standing by with expectations for the sector. Sonal.
Thanks a lot for that. And yes, in oil and gas companies, the macro picture remains that the Brent crude prices, they shot up 11% on a quarter-on-quarter basis and 47% on a YOY basis. Also, the benchmark refining margins stood at $6.4 per barrel versus $7 per barrel last quarter. In terms of the big boy Reliance Industries, we are expecting strong petchem performance that will be offset by slightly weak refining performance, but overall profit increase of around 3% is expected on a sequential basis. Going to the oil marketing companies, inventory gains will be offsetting the weaker performance in the refining segment. That is because of the higher crude prices. However, marketing segment EBITDA also is expected to be lower this time around. In terms of upstream companies, crude realizations is expected to be at around the $72 per barrel mark, considering the higher crude prices that we saw. Let's go across to the gas companies, where we are expecting strong performance this time around because of the higher gas volumes that we'll be seeing. Back to you.
Okay, that's a lot of companies Sonal has covered, from Reliance to oil marketing companies to gas companies. Gautam, any particular earning you would be bullish on?
So I think, Lata, this quarter, again, you have to look at on a 2-year CAGR basis because the base was extremely depressed.
Yes.
For our universe, the base had a 26% decline in the profits. In this quarter, we are projecting around 40% plus profit growth. Obviously, oil marketing companies will have an outstanding quarter because of the low base, but QOQ there will be a decline because the marketing margin has come off. Gas is something as a play which we like, so we have preference for Petronet, we have preference for IGL. Upstream companies obviously are expected to have a very strong quarter because of the prices where crude are. So overall, it should be a good quarter. In fact, if you remember, last 2-3 quarters, metals plus oil and gas, both the deep cyclicals, have been leading the earnings from the front. And in fact, this quarter also, we are expecting metals plus oil and gas to account for almost 60% of the incremental earnings growth for our total MOSL universe. So I think both the cyclicals will have a very solid quarter once again.
Okay, they lead from the front. But on that note, we will take a short break. But we are back, and stay on because there are lots of interesting sectors that we will analyze. Most important, of course, being cement, NBFC, and of course, consumer sectors.
Welcome back to our earnings special, quarter se quarter tak. With us still to discuss the sectors, the previews are Gautam Dugar of Motilal Oswal Securities and Sanjeev Bhasin of IIFL. We discussed about 4 odd sectors before we took that break. Let's move on to the next one. Cement is what we're talking about. Nigel is back with to tell us what to expect from companies in that space. Nigel.
Well, Credit Suisse says that they expect a weak quarter for the cement industry. Why is that? Because the price increases have not been as much as the input costs that have spiked up. In terms of volumes, they are working with a volume growth of around 7% approximately on a year-on-year basis. The price increase has been a marginal 1% on a sequential basis. Weakness has been seen as in the north as well as the east regions. But the problem is that diesel as well as petcoke prices, they're up between 7 to around 12%, and that's what would hurt margins. Edelweiss, they say in terms of Ultratech Cement, volume growth should be there, more than 30%, but EBITDA per ton should decline by more than 25%, while Edel says in terms of Ambuja Cements, volume growth should be around 5 to around 6%, but EBITDA per ton should decline by around 21% on a rather high base.
Okay, thanks for that. Nigel, cement always is that sector which one hopes is going to fire away because of affordable housing or some project or the other. Gautam, keep the faith?
No, actually, I am not too positive on cement. If you remember the story of cement over the last couple of years, either one or the other thing goes wrong and somehow things don't flow to the bottom line. Sometimes you don't have pricing, sometimes you don't have volume, and when you have both, you don't have cost in your favor. In fact, this quarter also we are expecting a very muted performance of around 3% growth on a very low base. So while one can keep hoping about the revival at some point of time in FY19 or FY20, the numbers don't look too good at the moment, whether it is large cap or mid cap. Right now the problem is cost pressure, so even if you have 7-8% volume growth, you're not getting pricing because the largest player in the sector is gunning for more volume market share, and therefore the pricing in the sector is kind of squeezed, and at the same time you have pressure from the cost element. So bottom line now is not looking very rosy. we have a slightly cautious stance on the sector at the moment.
Okay, the narrative seems to be weakening a little bit for that space. Well, we are moving on from cement to the NBFC sort of space. All kinds of varied companies, actually sectors within the NBFC sector. Abhishek Kothari is back with us to give us a preview for the important companies there. Abhishek.
Amongst the NBFC space, loan growth has returned to the gold financing companies. However, Manappuram is to take a hit on rising cost of funds, while Muthoot Finance can see a strong traction in the balance sheet growth. The consumer and two-wheelers sector is expected to do well. So Bajaj Finance, Shriram City Union Finance and Muthoot Capital are expected to show strong performance. In the housing finance sector, intense competition could lead to lower loan growth, while net interest margin could remain under pressure owing to the fact that cost of funds has gone up. In the MFI and small finance bank, expect moderate performance from Ujjivan and Equitas owing to the fact that their balance sheet is expanding and they are turning their operations into a small finance bank, while strong performance is expected from Bharat Financial. The vehicle finance sector is on an uptrend. We have seen with CV growth being strong in Q1 FY19, and that should aid for strong performance from Shriram Transport, Cholamandalam, Sundaram, MMFSL, etc. Back to you.
Okay, thank you very much. So CV Finance is expected to do good according to Abhishek's poll. But Sanjeev Bhasin, you tell us, should we be prepared for any accidents at all? Some people not able to manage the interest rate, rising interest rate tide?
No, from the indication which we got, I think most of them indicated that slightly higher cost of fund will get absorbed in their margins, and margins actually might surprise. That is what the guidance we got from Cholamandalam. The star outperformer will be Bajaj Finance. Last three quarters were slightly weak, but last quarter they surprised on the asset quality improvement. And I think that will again hold, the numero uno place. For us, the dark horses would be Group Finance, which has grown very sharply in the small and medium loan finance on mortgage, and India Bull. India Bull actually could surprise, given that last quarter they indicated and raised some money on the lower side. So these three would stand out, but it would be Ujjivan in the microfinance, where the scheduled bank license and the lower cost of funds could see maybe margins expand on the upside.
Okay. Gautam, what would you focus on? What kind of NBFC? I mean,
including insurance, everything, if you can tell us.
See, I think NBFC has been a perfect story playing out for the last 3 years. I mean, when I look at my Excel sheet over the last 20-30 quarters, I don't see a single quarter which was a big disappointment. And this quarter obviously is again expected to be very strong. We're expecting almost 37-38% growth for our universe, which is coming on a reasonably high base of 20-21%. And this is a very broad-based performance. I mean, keep aside SCUF or a LIC Housing Finance, rest all our pack is growing upwards of 30-35%. What we like within the space is vehicle financiers. We like Bajaj Finance. We like HDFC as well. We think that valuations on HDFC are very attractive at this moment. So there is a very good story playing out both for private banks and NBFC. They continue to be the beneficiary of value migration. In fact, that value migration from PSU to this 2-pack has accelerated in the last 6-9 months. So despite rising cost of funds, the growth is going to look very strong.
Okay. Well, we have about 6 minutes to end of show. So let me see if we can pack more. Anisha is here to tell us what to expect from power and consumer durables. Anisha.
Well, we might be looking at a muted generation growth for the electricity generators, anywhere between 2 to 4%. And the reason is that the quarter was really marked by coal issues. First, of course, the price of imported coal went up by around 30% year on year. And secondly, there was acute coal shortage across the country, and that really dampened the production numbers. For example, even hydroelectricity was down about 25% year on year. Other than that, if you're looking at the consumer durable space, well, there also the unseasonal rains actually dampened the mood quite a bit. Blue Star, for example, told us that the AC industry might be looking in or bracing themselves for a decline in the quarter gone by, while Whirlpool told us that demand of other appliances is not as weak as cooling products, so we might see a bit of uptick there, but overall expected to be a bit of tepid quarter.
Gautam, consumer appliances and again different categories, fans, switch gears, cooling products. Any thoughts here? Not exactly a hot quarter in that sense. Hot quarter in terms of temperature, but not in terms of performance. Go on.
Yeah, so as you said, Voltas, Blue Star, both will have a very muted quarter, and the management themselves have indicated that, I think, at different points of time during the quarter. Within the space, what we've liked is both the consumer electricals, which is Crompton and Havells, and I think Havells is going to report a very solid quarter this time around. More than 60% growth we are expecting, obviously helped by the low base of GST. Crompton also we continue to like. It's a very strong premiumization story playing out, plus they have a lot of room for distribution expansion and very high quality management, plus good pricing power as well. So all the ingredients of a good consumption and premiumization story are in place for both these companies. So we would look to buy at any correction in those stocks.
Okay. Out of time, Sanjeev, from Anisha's power and durables list, any thoughts?
So Lata, I think NTPC and Power Grid could stand out, but you would expect volumes which have grown. But like we said, the issues have always been around the coal, linkages. But I would expect numbers to be in line. There is not much expectation. Maybe some sort of margin expansion could surprise on the upside. But I would definitely agree that Havells and Crompton Greaves could stand out on the consumer electrical. But my dark horse there would be Voltas, given that their engineering business in the Middle East is seeing a lot of traction, and that could be the added kicker on Voltas.
Okay, gentlemen, thank you very much for joining us with your thoughts, and all of you out there, thank you for watching. Hope we have prepared you for the coming earnings season.